Ladies and gentlemen, we are 48 hours from the event horizon. Silver just collapsed to $74 on your screen. Red candles bleeding across every chart. Panic sellers flooding the exits. The headlines scream crash. The algorithm whispers sell. But here's what they're not showing you. While Western exchanges burn with selling pressure, China is paying $89 per ounce. Physical silver, cold metal in Shanghai vaults, a $15 premium. $15 per Nelson ounce. This isn't a market, this is a trap. December 30th, the ghost week. Trading desks are empty. Liquidity is bone dry. Volume is a corpse. And someone just pulled the trigger on the greatest smokescreen in silver history. You're watching two different realities collide. Paper silver drowning in New York, physical silver vanishing in Beijing. One screen shows red, the other shows a vault door slamming shut. This is the widest east-west premium gap in 24 months. The physics are screaming. The data is flashing red sirens, but the crowd is running toward the fire exits while the real players are backing up armored trucks to the metal itself. January 1st is 48 hours away. China's new import regulations activate, the vaults lock, the supply chain snaps like a frozen chain in a blizzard. If you're feeling the fear, good. That means you're still paying attention. But if you sell now, you're handing your wealth to the sharks circling in the dark water below. This is not a crash. This is an engineered panic, and the clock is ticking. Let's talk physics. Let's talk numbers. Let's talk about what's actually happening beneath the surface while your screen bleeds red. Comex silver, $74.20 spot price. Paper contracts, digital entries on a server in Manhattan. Shanghai Gold Exchange Premium, $89.50 for 1,000 ounce bars. Physical delivery, trucks rolling, metal changing hands. The spread, $15.30 per ounce, 20% premium. In a functioning market, this gap closes in hours through arbitrage. But we're on day 6. The gap is widening, not closing, widening. Why? Because there's no metal to move. Comex registered inventory dropped to 67.3 million ounces last week. That sounds like a lot, until you realize JP Morgan alone holds claims on 89 million ounces in paper derivatives. The leverage ratio just crossed 1.32 to 1. For every ounce of silver sitting in the vault, there are 1.32 claims on that same bar. Musical chairs, with bulldozers instead of children. Now look at the withdrawal data. In the last 72 hours, 4.7 million ounces have been flagged for physical delivery. Eligible inventory is getting gutted. Warehouses in Delaware and New York are running forklifts on overtime, loading trucks bound for ports. Destination? Shanghai. China's State Administration of Foreign Exchange just released December import data. Silver imports up 340% year over year. Not a typo. 340%. They're vacuuming metal from every corner of the planet. And here's the kicker. On January 1st, new strategic resource security protocols activate. Any entity holding more than 500 ounces of silver on Chinese soil must register with the Ministry of Commerce. Penalties for non-compliance, asset seizure, and criminal charges. Translation: China is locking the vault, and they're doing it in 48 hours. Meanwhile, on the paper side, the algo traders are feasting. Thin holiday volume, low liquidity. A few thousand contracts dumped at 3 a.m. EST, and the price craters $3.14. Classic bear raid, shake the weak hands, trigger the stop losses, harvest the panic. But look at the US Mint data. Silver Eagle. Sales in December, 4.1 million coins. That's the highest December on record since 2015. Retail demand is exploding while the paper price collapses. The crowd is buying the dip with both fists, while institutions dump contracts. This is the signature of a manipulation event. You want more proof? Look at the dealer premiums. Local coin shops are charging $9 over spot for Silver Eagles. Online dealers are sold out or delaying shipments by 3 to 4 weeks. Wholesale distributors are reporting allocation delays from the mints. The metal is vanishing, but the price is falling. Physics doesn't work this way. Supply and demand don't work this way, unless someone is rigging the scale. The paper market is a ghost, a hologram projected on your screen. The real market, the one where trucks and ships and vaults matter, is on fire. Premiums are spiking. Delivery delays are stretching. Inventory is evaporating like water in the desert sun. And in 48 hours, the biggest buyer on planet Earth is slamming the door shut and keeping everything inside their borders. This isn't a crash. This is a transfer. Wealth moving from west to east. From paper hands to iron vaults. The red candle on your screen is bait. The discount is an illusion. And the clock is counting down to the moment the trap snaps shut. So who's pulling the strings? Who benefits when silver bleeds on Ghost Week and premiums explode in the East? Let's name names. The algorithm, the central banks, the Eastern vaults. The same players who've been running this game for decades. Here's the mechanism. It's called the discount drain. Step 1. crashed the paper price during low-volume holiday trading. A few billion in futures contracts dumped in the dark hours before dawn. No resistance, no buyers, just a vertical red knife slicing through support levels. Step 2, trigger mass panic. Retail stops get blown out. Margin calls hit leveraged traders. The headlines scream silver collapse. Fear spreads like wildfire through chat rooms and forums. Step 3, while the West is selling paper, the East is buying metal. Shanghai traders wire dollars to Comex. They demand physical delivery. They load the bars on planes and ships. The arbitrage is a one-way vacuum, sucking metal from west to east. Step 4, lock the door. January 1st. China's new regulations make it nearly impossible to export silver once it crosses the border. The metal flows in, but it doesn't flow out. This is a bear trap designed to drain Western vaults while the crowd is distracted by holiday lights and year-end panic. And who's orchestrating this? Follow the incentives. China holds $32 trillion in dollar-denominated assets. Their currency is under pressure. Their economic growth is slowing. They need hard assets: gold, silver, copper. Anything that can't be printed by a central bank in Washington. The Comex is their shopping mall, and Ghost Week is their Black Friday sale. But it's not just China. Central banks in the West benefit too. A collapsing silver price keeps inflation optics low. It keeps faith in the dollar strong. It prevents a run on paper currency when the crowd realizes the game is rigged. The manipulation is a two-sided operation. The East wants the metal. The West wants the illusion. And here's the beautiful trap. Most traders are playing with paper. Futures, ETFs, digital claims on metal they'll never touch. When silver crashes, they sell. They take their loss, they move on. But the smart money? They're standing at the Comex delivery window with wire transfers and warehouse receipts. They're converting paper into bars, digital into physical, illusion into reality. This is the greatest wealth transfer of the decade playing out in real time. While the amateurs sell at $74, the professionals are paying $89 and loading trucks. The rigged game isn't hidden, it's happening on every screen, but most people are watching the wrong screen. The paper price is theater. The physical premium is truth. The Comex inventory is draining. The Shanghai vaults are filling. And in 48 hours, the door locks and the game resets. You're not watching a crash. You're watching a heist, and the getaway vehicles are already speeding toward the port. The villain isn't hiding in shadows. They're operating in broad daylight, using your panic as fuel, using your fear as cover, using Ghost Week as the perfect smokescreen. The clock is almost at zero. So what happens next? The gap closes, but not the way you think. The paper price doesn't rise to meet Shanghai. Shanghai supply runs dry and the West wakes up to empty shelves. January the 2nd. Markets reopen. Trading desks come back online. Fund managers return from vacation. They check their screens. They see $74 silver. They check their inventory and they see nothing. That's when the panic flips. The selling pressure evaporates. The buying pressure explodes. Every dealer, every refiner. Every industrial user who needs silver for solar panels and electronics starts scrambling for metal. And there is none. The premium gap doesn't close. It detonates. We're looking at a potential 20 plazers overnight gap up when reality meets delusion. When paper traders try to take delivery and realize the warehouse is an empty concrete room with a forklift and a phone that goes to voicemail. But here's your decision point. Do you sell now for fake paper dollars? Do you panic into the red candle and hand your silver to the sharks at $74? Or do you hold the metal and wait for the reset? History is screaming the answer. Every major silver shortage in the past century ended the same way. Vertical price spikes. 1980, 2011, 2020. The pattern is burned into the charts. This time, the shortage is bigger, the manipulation is clearer, and the clock is 48 hours from detonation. If you're holding physical silver, you're holding the winning lottery ticket. Don't trade it for paper confetti. If you're watching from the sidelines, understand what you're witnessing. The end of the paper-silver illusion. The moment the music stops and everyone realizes there aren't enough chairs, the vaults are locking, the premiums are exploding, the inventory is vanishing, the crowd is still selling into the fear. This is your moment. This is the crossroads. January 1st. The ghost week ends, the trap snaps shut, and the greatest silver squeeze in modern history begins. History is watching. The vaults are closing, and time is almost up. Subscribe, share, and hold the metal. 48 hours.